Thanks for coming. We got a great panel today. Our topic is the government and the mortgage market and the impact on housing. So as you know, this is a real topical topic, and I think we have a lively debate and hopefully augmented by your questions. So feel free to raise your hand. We have John Chauvin, when he was listing the big four issues facing the country, he listed fossil fuels and climate change, aging, the budget and government spending, and inequality, but he didn't say housing. So I don't know what he was thinking of. I mean, this is like on top of everybody's mind. So we're going to address that today. The provision of adequate and affordable housing, I might say, renting or buying. We have just two things starting off. There's a list of issues on your chair, and just to run through them real quickly, we're going to talk about what the appropriate role of the government and the GSEs is in the mortgage market. Just two acronyms. GSE stands for Government-Sponsored Enterprises, which are Freddie, Fannie, and the Federal Home Loan Banks. The FHFA will be mentioned, probably. That's the Federal Housing Finance Authority Administration, and it's the regulator and the conservator of the GSEs. And then FHA, of course, is the Federal Housing Agency, and that's the government-owned entity that does housing for low-income housing. So the first one is the appropriate role of the government and the GSEs in the mortgage market, and we'll talk about kind of in two parts. One is the prime mortgages, and the other are affordable housing, so low-income mortgages. We'll start off by dividing those up into those parts. Then a very important question is who should pay for U.S. government support of mortgages? The taxpayers, which are paying now, lenders, borrowers, other. Third, about the maintenance, do we want to keep a 30-year fixed rate mortgage in play in our country? As you know, most countries do not have a 30-year fixed rate mortgage. And then lastly, what's the impact of these GSE restructuring alternatives on the housing market and housing prices? So hopefully we'll get through all that. What we plan to do today was ask our panelists to my left to have a brief discussion of these issues before we take questions, and then leave hopefully about half the time for questions and interactions with you on all these issues. Two things, there are several bills that have come out. In fact, one agreement in principle just came out on a bill to restructure the GSEs just this week. The first one that came out is authored by Jeb Hensarling, who's in the House, a Republican from Texas, is the chair of the House Financial Service Committee, and he basically has an objective of abolishing the GSEs. The second one that came out was a bill by Corker and Warner. Corker's a Republican from Tennessee, Warner's a Democrat from Virginia in the Senate. And one of the key aspects of that is the government takes a position as the ensuring the excess of loss through something called the Federal Mortgage Insurance Corp, and the private sector takes the first 10% of loss. And those were both came out last year. Then on Tuesday, agreement in principle was announced by Senator Johnson, a Democrat from South Dakota, who's the chair of the Senate Banking Committee, and Senator Crapo, who's a Republican from Idaho, is the ranking minority member of the Senate Banking Committee. And only in Washington fashion, basically they took a year and then took basically the same bill and changed the name at the top. So it's very similar to the Corker-Warner bill. Why it took an extra year, who knows, but that's the way it is. We also we're not really going to, we have copies of the press release from the Johnson-Crapo proposal. It's not a bill yet. The details haven't come out. And there are other bills that are rumored. Maxine Waters is rumored to have a bill. Maloney, a Democrat from New York. Delaney, a Democrat from Maryland. So they're all, it's still a lot in play. We don't think these things are going to come to fruition very quickly. In fact, Senator Warren has already come out and said we need to take our time and look at it. So we don't really plan to discuss the details of the bills because it's just too uncertain and too far in the future. Also, another issue that's current and is a lot of fun, but we don't plan to discuss either, is there some shareholder suits against Freddie and Fannie. Really, the suits are against FHFA, the regulator, and the Treasury. They're suing the government for absconding with all of the earnings of Freddie and Fannie and paying dividends to the government. And we don't plan to talk about that either. On both issues, both the bills and the suits, you can ask questions if you'd like. Frank and I are currently in the employ of Freddie Mac, so we can't comment on either one, but maybe these two guys in the middle will be able to give you their view.
You're opening yourself up to have a bank comment on Freddie and Fannie?
Without me being able
Looking forward to it.
Without me being able to talk.
Thank you.
Let me introduce the panel. So to my immediate left is Ken Bacon. He was a co-founder and managing partner of Railfield Partners. He's a director of Comcast Varsity Enterprise. Formerly, he was the EVP at Fannie Mae and head of the multifamily business, and a former Stanford trustee. He got his BA at Stanford, master's from the London School of Economics, and an MBA from Harvard. To his left is Ron Sturzenegger. He's at Bank of America. He's in charge. He's got the enviable job of being the legacy asset servicing executive. So he has all of the old mortgages portfolio that he's working out and doing a good job. And he's a member of the executive management team of the bank. And he was formerly an investment banker at Bank of America Merrill Lynch, managing director, global head of the real estate, gaming, and lodging group. And I just want to comment that it's very unusual to see these investment bankers take on an operating role, so we appreciate that. Thank you very much. To his left is, Ron has a BSE from Stanford and an MBA from Harvard. To his left is Frank Nothaft, and he's the Freddie Mac chief economist. He was formerly at the Federal Reserve as an economist, past president of the American Real Estate and Urban Economic Association. He has a BA from NYU and a PhD in economics from Columbia. And I'm Eugene Shanks, and I am a member of the SIEPR Advisory Board and former president of Bankers Trust Company. I'm on the board of Freddie Mac and ACE, the insurance company. I also attended Vanderbilt for a BA and have a PhD in economics from Stanford. So too bad President Hennessy is not here because we have 3 Stanford degrees, plus if you add us all together, we have 7 children that have been to Stanford. So we represent 10 tuitions. That's a lot of money. A lot of money. So, but the bad news is we have 2 Harvard degrees, but you can't have everything. Okay. So before we get into issues, I've asked Frank to kind of lay the groundwork for our discussion today. And he has some charge that you've been given to give some basic data on mortgages and housing, so we all start with kind of the same database.
Well, thank you, Gene. It's a pleasure to be here to speak about the housing finance system in the U.S. I'll start with just an overview of the depth and breadth of that system, and then share some information about the delivery and financing of home mortgages in the U.S. And as a card-carrying economist, of course, I'll have numbers and some charts, as Gene mentioned in the handout, that I'll refer to. First, just in the overview, there's about 50 million mortgages secured by housing in the U.S. 50 million mortgages. So it's a very, very deep market. And if you add the dollar balance of each of those 50 million loans, it totals to $10 trillion in residential mortgage debt outstanding in the United States. A very big number. And to put that also in some context, if you sum up all of the credit outstanding and held by the private sector in the U.S., add up all the commercial, industrial business loans, commercial mortgages, student debt, auto debt, add up all the credit, municipal bonds, add it all up, residential mortgages are just a little over 25% of all of that credit outstanding in the U.S. So it's a very big market. And it's not only a very big market, but it's one with a lot of churn, a lot of vibrancy in it. If you look at the flow of new originations just in the last 2 years, it sums to $4 trillion. So that means 40% of all of the mortgage debt, housing mortgage debt in the United States was made just in the last 2 years. And of course, as you know, a lot of that is refinanced, most of it is refinanced, but it's a very vibrant market. And many policy analysts who write about the mortgage market often refer to this unique feature of the American mortgage. That is a mortgage that is long-term, fixed rate, no prepayment penalties, and with generally no or very limited recourse back to the borrower. And if you compare the American housing finance system with those in other countries, it is truly unique by having that collection of attributes to it. How is that credit delivered and financed in the U.S.? Well, if you look at the primary market, and the primary market is where borrowers come to lenders in order to get their mortgage loans. So if you look at the primary market, what you see is there's a great deal of diversity in types of lenders, and also a great deal of heterogeneity in terms of the size. So you have a relatively small number of lenders that are active throughout the country, about 10 lenders who account for about half of all the mortgage lending in the United States on housing. The other half of the lending is accounted for by about 5,000 additional lenders. And these 5,000 lenders are, of course, a lot smaller. They include community banks, credit unions, independent mortgage companies, regional banks. So you get a great deal of diversity in the type of lenders who are delivering the product to borrowers. Now, how is it financed? Well, every December I always like to look at It's a Wonderful Life, and the way mortgages are financed today are so different than what's depicted in that movie. And indeed, we've had such an evolution in how mortgages are financed in the housing finance system over the last 40 years. Rather than mortgages primarily being financed by bank deposits, mortgages are primarily financed by securitization. In fact, if you add up all of the deposits in the U.S. banking system, you get about $10 trillion. So you can see with the $10 trillion in banking deposits, it's really not sufficient to finance $10 trillion in residential mortgages, because banks are also financing C&I, commercial industrial business loans, commercial real estate. They're also financing municipal governments. They're financing other forms of consumer credit. So we need some additional supplement in order to finance the mortgage credit needs of America's families. And that's indeed the role played by securitization over the last 40 years in the U.S. And through mortgage-backed securitization, it taps into a broader investor base. That includes life insurance companies, pension funds, foreign investors that bring funds into the housing finance system in order to supply and meet the credit needs of America's families. Now, in the charts, I've included some information on the volume of issuance of securities over the last few years. In fact, if you turn to the slide number 3, which is the second slide, MBS market presence, you can see that we're talking about a substantial amount of new mortgage-backed security issuance per year. And over the last few years, since the crisis in the housing market, the record level of foreclosures, the Great Recession we went through in the U.S. economy, mortgage-backed security issuance is really dominated by 3 issuers. That's Freddie Mac, Fannie Mae, and Ginnie Mae. And between the 3 of them, Freddie Mac, Fannie Mae, and Ginnie Mae, about 90% of the flow of new originations are financed through those 3 organizations. It's a big sea change from how mortgages were financed prior to the crisis, or how they have been financed for a long time. While securitization has played an important role, securitization typically did not finance 90% of the flow of origination. So that's a new development over the last few years. And as you probably know, Ginnie Mae is a government agency. It's part of the U.S. Department of Housing and Urban Development. So Ginnie Mae securities have the explicit guarantee of the federal government. Freddie Mac and Fannie Mae are in conservatorship, 80% owned by the U.S. Treasury as a result, and effectively have the guarantee of the federal government standing behind it, the securities that we've been issuing the last few years. So we have a marketplace with a very large government presence since the housing crisis, with, again, 90% of the flow of new originations being financed by Freddie Mac, Fannie Mae, and Ginnie Mae. And for the overall quantity of mortgage debt outstanding, well over half of the residential mortgage debt, the $10 trillion of mortgage debt outstanding, over half has been securitized or held in portfolio by Freddie Mac and Fannie Mae. And if you add Ginnie Mae to it, it brings you over 60%. And the last slide in the handout shows that evolution over the last 60 years in who holds mortgage debt and how things have evolved with securitization playing such an important role in financing the credit needs of America's families going forward today and for quite a number of years. Well, I stop there.
That'd be good. You might just comment on the relationship between Ginnie Mae and FHA.
Sure. As I mentioned, Ginnie Mae is a government agency. It's within the U.S. Department of Housing and Urban Development, but specifically, Ginnie Mae is only authorized to guarantee pools of FHA and VA mortgage loans. So in the primary market, we make a distinction between FHA, VA, and conventional loans. Conventional loans referring to those loans that do not have a federal insurance or federal guarantee behind it. So Ginnie Mae guarantees only pools of FHA and VA, federally insured or federally guaranteed mortgages. In contrast, the activities of Freddie Mac and Fannie Mae are almost exclusively to support the conventional mortgage market, providing the liquidity and the stable flow of funds to finance conventional mortgages.
Okay, thank you. Okay, we're going to go into a brief panel discussion on the question number one. What is the appropriate role of the government and the GSEs in the mortgage market? And specifically, A, should the U.S. government support prime mortgages and secondary market liquidity? If so, to what extent and through what mechanism? And I'm going to ask Ron to lead off on that.
Yeah, thank you. So a couple of things. I'm going to play off the word role and support, if I could. The first thing, and Frank just said it, when the government is behind 9 out of 10 mortgages in America, that's not a market, that's a program. That's a government program. So if the question is, do we have a mortgage market in America today, I might suggest it's kind of hard when 9 out of 10 of those mortgages that get done were actually somehow government sponsored. So I think there's clearly we need the role of government is helpful, and I'll talk about role in a second, but support, when you support 90% of what gets done in the marketplace, that may be a little more influence in the market that I think that most of us would like to see long term. And then we have to have a lot of discussion about short versus long term, because if you have been doing 90% of something and you stop doing it quickly, that leaves a very large void in the marketplace. But let's go back to the word role. Government clearly has to have a role in the mortgage market. But how should that government use that role? Well, clearly they're there for regulation, right? They need conformity. We need people understand the mortgage. We need to have some liquidity. We can talk about that in a second. But most of all, they have to make the people who take out mortgages feel comfortable that what they're getting is a fair deal and the information behind that loan is fair and understandable. That really is the role of the OCC for a very long time. Now we've got the new I hate to use all these acronyms, I'm sorry, because we use them every day. So OCC is one of the regulators. They regulate banks for safety and soundness. We have a new regulator just showed up called the CFPB, the Consumer Finance Protection Bureau. They're new. They're another regulator for make sure that consumers get treated fairly. I always say the Fed, which has been a long time regulator, again, for banks, safety and soundness. All of that's necessary to make sure that the mortgages that we put on the balance sheet and the mortgages that we securitize are in the market safely. And again, so you want the consumer who gets the mortgage to feel that that mortgage is a fair mortgage, has been properly diligenced, and that they understand it. And then when you sell it into the marketplace, either with a guarantee from a Freddie or a Fannie or a Ginnie, that the buyer of that mortgage, the investor from a securitization standpoint, gets a fair piece of paper. All right, and again, the government can have an involvement in all of that. That's the role. Support is a little different. That's when the government actually reaches into its pocket and spends money to assure, and guarantee or insure. And again, Freddie and Fannie for very many, a long time, sort of had that implicit guarantee, but wasn't necessarily paying for it. And I think that's part of the question we have to ask ourselves going forward. In a transparent market, if someone gets a guarantee, if someone buys a piece of insurance, we got to at least acknowledge what the cost of that insurance is and who should pay for it. And I know we're going to jump into that in another part of the conversation. So again, I guess my conclusion is government has to have a role. It's more from a regulatory and a protection standpoint. When it comes to actually reaching into their pocket and spending money, I think we need to spend a little more time defining what level and what types of support the government needs to have.
Thank you. Ken?
Thanks. I just want to add a few comments on that because I think a lot of times people, as the debate goes on, about the government role and support, there's often the question of why. Why should the government do it? Because you could ask, and I think people will be asking this about student loans in a few years when that blows up, as it will, but why this form of debt should be selected over all the other consumer receivables. And I think there are several reasons. Number one is just the sheer size of the market. This is a huge market. And just because of the sheer size, the government has to watch it, particularly because of the participation of depositories. And if you look, I've been in mortgage business in one shape, form, or fashion since 1982, and people used to worry about junk bonds, sinking banks. The product that has ended more banks, more careers than any other has been just a plain old mortgage. Why is that? So what is it about this product that necessitates such a special role? And it's due to the inherent complexity of the product. If you are into Black-Scholes and you're into option, there is no product with more embedded optionality than a 30-year fixed-rate mortgage. No prepayment penalty. So you have, in addition to credit risk, you have an interest rate risk component that makes this a very complicated product. The interest rate risk has brought down a lot of organizations because, again, people find themselves, interest rates change, and all of a sudden mortgages prepaid, people have borrowed to buy the mortgages, boom, they're in trouble. So just the size of the market, the complexity of the product, but then there are two other dimensions that don't get talked about enough. One is the psychological importance of mortgages. You know, there are countries around the world that have home ownership rates that exceed that of the U.S. Mortgages aren't as big a thing, but in the American mythology, we've always preached that home ownership, good for the neighborhood, good for your soul. When we had the John Chauvin, actually it was the gentleman from MIT, when he was speaking about components of wealth of the elderly, what was the biggest part? Home equity. So again, in this country, home ownership has not only been a form of shelter, it's also been a form of savings. And then there's the politics of home ownership. One of the things I learned in my career at Fannie Mae, not every congressman has a big bank, not every congressman has an army base, but every congressman in the country has a realtor. Every congressman in the country has a home builder. So you have industries that care passionately about the availability and the pricing of mortgage credit. So this is one of the things that's made it very difficult. As you heard Leon Panetta talk about the budget, this is a product that politically a lot of people care about. So I think because of those things, that's why there's not only a government role and support, but it is a very pervasive, very large, and a very strong support because of all these reasons.
Okay, thank you. You want to go on and talk a little bit about affordable housing?
Yes. The question comes up, should the U.S. government support affordable housing? If so, at what level and through what mechanism? Over lunch today, Gene and I were having a talk, and one of the myths of the most recent crisis was that affordable housing. So if you read the popular press, people blame Fannie and Freddie's demise on affordable housing. Well, that was not true. Affordable housing caused some problems, but it was really what I call the no-doc, low-doc, middle-class housing speculation, as Ron could tell you
Absolutely.
chapter and verse. But the thing about affordable housing is affordable for who? If you look at all the mechanisms that the government has come up with, I would say, yes, the government should support affordable housing, but it needs to be more narrowly defined. Because, for example, there's a difference between me at 59, I still get the benefit of a subsidy if I get a Fannie or Freddie loan. This is now my fourth home. So do I need affordable lending? No, but I get the same benefit as a person who's 25 buying a home for the first time. I also get the ability to deduct the interest on my mortgage. So I would argue that, yes, the government should support affordable housing, but we've created a lot of mechanisms that, like a lot of entitlement programs, have grown to the point that affordable housing tools are now used to support people who don't really need that. I would argue that, yes, it's needed because we want people to buy a home, but I would also argue that we've got maybe too many mechanisms and it's very hard to target the benefit and to even measure the benefit. And there have been lots of studies done on the mortgage interest deduction, for example, and guess what? Very few lower middle class people actually itemize deductions, yet we still have that under the guise of affordable.
Eugene, can I take
Ron,
that?
go ahead.
Can I take that point as well? I couldn't agree more on that. I think we do need to subsidize first-time home buyers, low and moderate income buyers, people who are trying to get into communities. I think you all have to have your own opinion on that, but I think generally most people in America would vote to support something like that. And you make it first-time home buyers, you bring the pricing down per that community. But, you know, to Ken's point, we are still subsidizing large home buyers. People are buying $500,000 and $600,000 homes. People are buying their third and fourth homes because everyone who can get a Freddie or Fannie loan gets the implicit government guarantee, and Freddie and Fannie right now are holding the prices down. So they're holding, I shouldn't say, they're holding mortgage rates down. That's a better way to say it. So if you asked us as a bank, we can go out and originate loans, and this is the complexity of the business that Frank was talking about. Our balance sheet, banks' balance sheets cannot take all of the loans that are necessary to support our customers. So Bank of America does about 4 to 6% of all home loans in the country, right? And that is just too many home loans to stick on our balance sheet. It would swamp even our balance sheet size. So we take those loans that we make and we want to sell them. And we want to sell them into the markets. And we get a Freddie or Fannie guarantee without getting into too much complexity. And then we sell it into the market to some extent with a government rating on it. Very inexpensive. When we ask Freddie and Fannie, at what price can you sell those bonds? They come back and give us a price. And we turn around to the customer and we say, here's your price, and we sort of flow it through. Now all of a sudden, we're going to take that same loan and we're not going to go to Freddie or Fannie. We're going to put it straight into the marketplace. It used to be called a private label securitization, as in no government sponsorship. That's going to be a lot more expensive because the buyer of that bond says, well, geez, I used to have the government implicit guarantee through Freddie and Fannie. Now all I have is an 80% loan to value home, right? That's a little dodgier. And I'm going to add a couple of percent to it. So maybe instead of getting today's 30-rate mortgages 4.5-ish, give or take, it's 6.5. Well, by the way, a lot of us have bought houses at north of 6.5% interest rates in the past, right? Until this most recent cycle, and sort of got by with it. But if that's why 9 out of 10 mortgages, when we go to ask a customer, what do you want? A Freddie and Fannie guaranteed loan that costs 4.5, or one I can put and get private capital into at 6.5. Everybody says, let's do the Freddie or Fannie approach. So again, that's sort of why we see ourselves right now in a market where every loan is going through a government agency, because again, using the government's pricing power, they are subsidizing all buyers. So anyone who wants to buy a house and anybody who wants to get a mortgage is somehow getting an implicit government sponsorship that I think that the American taxpayer is ultimately paying for. And I think that's the real question. So it's not just affordable houses, it's affordability of all mortgages that we have to think about.
You've led us perfectly into the next topic, which is who's going to pay for this?
Yeah.
Taxpayer, the borrower, lender, or somebody else? Ken?
In fact, of all the issues about the debate on mortgages right now, I'd say this is the most critical one because it's the old thing, everybody wants to go to heaven, nobody wants to die. If you go to the people that pay money to influence these things, the realtors or home builders want the cheapest money possible. So we have a system right now where I would argue that borrowers, while they pay some, they're not paying the real value. For example, if any of you are in commercial real estate, you know that if you get a loan, if you decide to pay it back 6 months from now, you have to pay a penalty because the lender will say, you know, I had to borrow money, I had to go out and issue debt, so all of a sudden you're bringing this back to me, well, you have to make me whole. They call it yield maintenance. Single-family home buyer does not pay for the optionality embedded in the mortgage. It's free. And again, they're also getting the fact that the GSEs, historically, the capital that they had to hold against their single-family obligations was very low. Very low. No bank regulator would have let anyone have capital that low. So again, the pricing that the borrower paid for just the credit risk was also below market. Now, some would argue that this is not necessarily a bad thing, but again, the fact is they didn't have a lot of skin in the game, and you then take the fact that I'm not paying anything for interest rate risk, I'm not paying a lot for credit risk, and by the way, I'm going to let you have your low down payment, and one could argue that the scales were tipped heavily in favor of the borrower. Meanwhile, the borrower. Meanwhile, the lenders, because of the way securitization worked on the single family side, also did not have a lot of skin in the game, at least previous to the current regime.
We didn't think we had skin in the game.
That's right, they didn't think they did.
Turns out we had both arms and a leg.
They found out. Yes, the U.S. attorneys and regulators said, you didn't think you did, but you
Turns
did.
out we did.
So if you look at what didn't blow up, the multifamily businesses of Fannie and Freddie didn't blow up in part, because of the fact that not only did the borrowers have a lot of equity in the game, there was also the fact that Freddie Mac kept the credit risk, all the credit risk on their books. Fannie Mae shared the credit risk with the lenders. So there was never any question as to where the risk was, and because of the fact they held the risk, they charged for it. And as a result, on an operating basis, Fannie and Freddie's multifamily programs did not lose money in the downturn. Their delinquency rates also did not skyrocket. So again, I would argue that yes, while the government should support and they should pay for some of it, the fact is, at the end of the day, under all the proposals now, which is why I don't think they have a great political future ahead of them, you know, the costs are going to shift more to borrowers, and I think there's going to be a big fight about that, because that will cause interest rates to rise as people have to pay more for the money.
Which will bring housing prices down ultimately as well, right?
Which, by the way, some people would argue that the combination of cheap money and the mortgage interest rate deduction has artificially inflated the price of houses. You know, we've got people saying, you know, I need to buy a house so I'll have savings for my old age. Is that an appropriate use of housing?
I take that, I couldn't agree more. Clearly, who pays for that government support? It's got to be two people, I think. It's got to be the borrower. They've got to pay a little more for it. It's probably also got to be the bond investor, because they're getting something of value. They're getting an implicit, and right now, an actual government guarantee. So let me just say, the person who shouldn't pay for it is the banker, right? We sit, I know y'all laugh about that. Funny I'd say that, funny.
I thought you were going to say the taxpayer.
No, the taxpayer ultimately, we're the credit provider of last resort, by the way. But think about what the lender does, the person in the middle. Again, a customer comes and wants to borrow money, right? We arrange a loan for them and we turn around and sell it, right? We were a conduit, right, to some extent. Right now, again, I'll go back to that role of the government and the role of regulators. They have to make sure that we underwrote it properly, that we did it fairly, that we didn't have stated income loans, right? That we did the appraisal properly, that we validated the person put equity into the property. That's all the responsibility. But taking the economic risk, I mean, again, when you make an 80% loan-to-value loan and the market drops by 40%, what do you think might happen? You want to make a guess? Do you make money or lose money? you probably lose money, right? So again, that's the risk you gotta take. So when we make an 80% loan-to-value loan and we turn and sell it to an investor who understands they're getting an 80% loan-to-value, a Freddie or a Fannie, and it drops by 40%, you kind of expect a little bit of market loss there. But the person who made that loan is probably not the one who intermediated that loan was not really the one who was supposed to be taking that market risk, that interest rate risk, or that credit risk. And so again, if so, that financial institution in the middle probably also wasn't pricing its servicing right? The services were mispriced, as I think a lot of us have learned. A lot of people mispriced the housing market, and I think the banks are clearly one of the biggest culprits in the mispricing of that.
You know, one of the
Thank you.
interesting
Frank, jump in.
challenges is that if you do see a rise in conventional mortgage rates because perhaps higher capital requirements or higher compensation or higher costs paid by borrowers for getting conventional loan credit, it may just simply shift the mix of loans originating with borrowers choosing more FHA loans. Because we're not talking about increasing costs for FHA loans, what we're talking about is conventional loans. Well, FHA loans and the Ginnie Mae securities they get placed in have the explicit full faith and credit guarantee of the U.S. government. So raising the cost of conventional loans doesn't necessarily reduce taxpayer exposure. It's shifting it. It's shifting where it's distributed because you may shift more into FHA and into Ginnie Mae securities. And so that raises another set of questions about the overall riskiness and quality of FHA product.
Okay, let's move, we've mentioned this a couple times, move on to the, should the maintenance of the 30-year fixed-rate mortgage be a key objective of U.S. housing policy? Ron, you want to start on that one?
Yeah, I'll say a couple of things. So the number one financial, so I'll speak on behalf of Bank of America, the number one financial product our customers have is their house. It's by far, you saw the chart earlier today, it's the biggest asset they probably ever own. And by the way, going through the last 5 years where a lot of our customers unfortunately couldn't hold on to those houses, right? Or had to go through a modification process or a short sale has been probably the most challenging time for our customers in their entire financial lives and probably the whole sort of personal life. So it's not a good thing to lose those houses. 30-year mortgages are probably the best way to hang on to a house during a downturn because you've got 30 years of protection, right? And usually they've been priced fairly and economically. It's not a hindrance to movement. To Ken's point, if you get a job in another town, you can actually pay it off and move. So it does have that one-way optionality that I think was not priced properly, where the customer, the borrower, has total control. They can pay it off, they can walk away. It's not recourse. It's got a lot of great things behind it. The only issue is, so I think we need it. I think it's the right thing. Our country and our culture and home ownership is critical. It's important. I think it's just got to be priced properly. And I think we went through a phase where maybe, and I think we're in a phase right now, where we are not pricing that product quite properly. I think it's too inexpensive given the one-way option that we allow the borrower to have, both on non-recourse and on ability to pay off without any make-whole or any kind of, compensation to the investor who has the other side of that trade. And so I think those are some of the things that we got to think about. But I do think it's critical to have a 30-year mortgage, and I think this country has sort of built the housing market around that. And the last point I will make is home ownership, I think, has proven to make communities better. Right, people tend to invest in the communities, they stay in the communities, they get educated in the communities. I think home ownership is a very important social component of our country as well.
The 30-year fixed-rate mortgage is often referred to as a consumer-friendly mortgage. It's something that's very easy for people to understand, to budget for. And when you look at performance of 30-year fixed-rate mortgages compared to a 30-year adjustable-rate mortgage in the U.S., the fixed-rate mortgage has a much, much lower delinquency and default rate. I thought it was interesting, I think it was Jim Perturba earlier today, showed the financial literacy questions from that survey, and only 1/3 of all respondents got all the questions correct. So financial literacy is an ongoing challenge broadly in the U.S., and I think that's a reason that 30-year fixed-rate mortgages seem to perform better. They're consumer-friendly. They're just easier for the typical consumer to understand.
Yeah, I'm going to take the problem with 30-year mortgages. consumers love them, but if I had to design a product from hell for a bank regulator, it would be a 30-year mortgage. It's inextricably tied, with the need for GSEs. Why is that? Because it is impossible for most depositories in this country to portfolio a 30-year mortgage. Because how do you fund it? Savings and loans that used to dominate the mortgage business in the late 80s, when you looked at the chart on mortgage holdings, in the late 80s, there was huge what they call disintermediation. Because when interest rates changed, there were a lot of banks that, again, had lent long. They had made 30-year mortgages, and all of a sudden interest rates went up, and they had negative carry on the mortgages. So this is an example. I'm scared. I've got all these economists in the room, but I remember that when I studied economics, there was this 19th century British economist, John Say's, had this thing, Say's law. Sometimes supply will create its own demand. 30-year mortgages almost created the GSEs because there was a need for somebody who could invest in these things. And the reason the GSEs could invest is, again, we're getting back to the government support. They could issue callable debt to a degree that banks could not. What do I mean by callable debt? Fannie and Freddie every few months go out and they will issue 10-year paper, 20-year paper that they can call. Okay, so that means if interest rates move up, interest rates move down, they have the ability to manipulate that part of their balance sheet so they can match up the liabilities and the assets to a degree that a bank can't. So the problem with a 30-year mortgage is it almost requires that some government entity, either the GSEs or the Fed, is there to portfolio the mortgages because, again, there's no one else who can do it. So that's the downside of the 30-year mortgage.
Just a question on that. As many of you probably know, the GSEs are mandated now to shrink their portfolios. So one of those two sources you mentioned is going down dramatically. 15% per year, the portfolio has to decline. So we're left with the Fed.
Yeah, and I think, by the way, if there's another downturn, I think people would have to reverse that because, I mean, their portfolios have gone down, and the Fed has just got a huge position. But again, the Fed and the GSEs have the ability to do things that other people can't. And this is kind of the weak link in the system, that you've got a product that no one else can effectively manage.
Okay, thank you. Okay, just the last question is the impact of the GSE restructuring alternatives on the housing market and housing prices. Frank, do
Sure.
you have any comments on that?
Of course, the devil's in the details as to what the restructuring alternatives look like. But let's say it does lead to somewhat higher conventional mortgage rates. Somewhat higher conventional mortgage rates holding other long-term interest rates constant, okay? So let's say mortgage rates now are much higher relative to 10-year Treasury yields. In that case, that should have some negative impact on house prices, as Ron was referring to earlier. But a broader question, again, is the substitution among different products in the mortgage market. What happens to FHA rates? Is there some constraint on the availability of FHA? And again, these are issues that policymakers in Congress would have to deal with, because if you make conventional mortgages much more expensive, well, people will go to FHA. You can still get your 30-year fixed-rate mortgage. So it really depends on all the details as to how what the impact is overall on the housing market. And of course, you can mitigate the effects by having a lengthy transition period as well.
I'd say I don't think it's got to make mortgage rates go up. Right now you've got the best world ever. 9 out of 10 mortgages are made by government entities relying on government funding of debt. That's as cheap as it's going to get until it goes to 100%, I guess, right? But as good as it's going to get. So and again, I think we all agree, and if you look at all these proposals, every one of them is trying to get some private capital, to get somebody with some real skin in the game, but recognizing that in order to have a 30-year mortgage, you got to have some government support who can get that kind of liquidity and buy in and out long-term debt. So just conceptually, you could say, if I had an entity that was, the first 10% loss was private capital, the next 90% was government capital, Government gets priced at government, the 10% gets priced more expensive because it's risk, but when you blend that 10 and that 90, hopefully comes up with something a little more, a little more expensive than it is today, but it's getting longer term, more private capital into the business. I think that's what they're all kind of trying to figure out a way to do, and whether or not you have the banks own some of that 10%, right? Because the banks are the ones making that loan. I kind of get why you might want the originator to have skin in that game. I kind of get that, right? Because you want to make sure you make good loans and you keep paying attention to it. Or whether or not you get some private mortgage experts, a la Freddie and Fannie, but they're now that 10% piece, not the 90% piece. That's another way to think about it. But at least now you've identified, number one, the 90% person at least understands what they're doing. They're a government guarantee, right? Full stop, and you're paying for it, so at least they know what you got. And the 10% is the same way. What I still kind of find funny about this last cycle was that everybody was buying insurance from Freddie and Fannie. That's what we were buying. That's what they're insuring mortgages, right? But I kind of joke about that. They were only insuring your car if you scratched and dented it. If you crashed it, they didn't have the money to pay for a new car, right? So when things were, I'm not being, but when things were okay, and, we had 50 years of kind of good housing market, they had plenty to fix all the scratches and dents, because things went bad in the market all the time. But the first real crisis we had, we recognized that the insurance provider wasn't as well capitalized as they needed to be. And for the first time we had a crisis, they sort of stuck their hands in their pocket and said, whoops, sorry, we don't got the insurance, right? And so that was kind of what we found. So next time around, and by the way, and whoops, I don't have the insurance, had to go back to the government. The government stepped in and provided all of that insurance. So the insurer of last resort ultimately paid for it anyway. So if the insurance of last resort is going to pay for it, you may as well have them admit it, be that 90%, and then at least they get paid for the insurance they're providing. One person's perspective.
I would point it,
One person's perspective.
I would point out that the GSEs now have zero capital.
That's exactly right.
Well, as you can tell from this panel, I think if they have their way, we'll have higher guarantee fees and higher mortgage rates
Yep.
relative to Treasury. So I'm going to open it up to the audience to ask for questions. Yes, sir.
I have a question for Frank. Frank, so on that $10 trillion mortgage debt, what percentage today is 60 days past due or greater?
Oh, okay. Let's see.
And then what associated number of mortgages per 60 days is it?
Yeah. So it's about 2.5 million mortgages today. So again, out of 50 million mortgages outstanding, about 2.5 million are 60, or it might be 90-day plus delinquent.
Compared to
At the peak? At the peak, it was just over 5 million, which is about 10%, right? So that's a really, really high percentage. So for a
That
long
sounds low
period.
to me. That sounds, I think it was a lot
10
higher. Again, you have a much better portfolio. I mean,
10% is
I think if you look at the height of the crisis, it was closer to 13, 14% delinquent. Again, I don't want to tell you what, I know exactly what our portfolio was,
The
right?
private sector is much higher than the GSEs.
Totally fair. That's
It is.
fair. If you look,
That's
yeah.
total, these are the total.
mortgages you're saying?
Today, approximately, are 90 days delinquent. So that'd be about 5%
Sounds
ballpark, 5-6%
I bet that's right
of,
today.
Does that apply to outstandings as well as the number of mortgages?
that's the outstandings. It
That's
would be about
outstanding.
5-6%, or about 2.5 million.
Thank you.
In Freddie Mac and
Okay.
Fannie Mae's portfolio, it's a
Yes,
lot
sir.
lower, it's about 2.25%.
I've been involved in the real estate market for my whole career. Very interesting because, as I recall, Congress was very instrumental in helping create the problem. Because as I remember, it used to be the good old days when Ken Bacon and others were looking things, actually looked at credit quality, but somebody in Congress, I believe, decided that the home ownership rate would only improve if we could increase home ownership, which suddenly created a strong pressure to create what we now know as a subprime mortgage. Didn't exist back then. So when you look at the problems and you say there are the incentives, the deductibility of interest, when you look at the fact that a 30-year mortgage, first of all, the average, person holds a mortgage for 7 to 8 years, then they sell their home and move on. So 30-year, whether it's really critical. But for our perspective was, we used to have a home ownership rate of around 64, 65%. But the pressure was on all the institutions, including the GSEs and everybody else. You've got to get more people in homes. In fact, we're going to criticize you if you don't really accommodate that. So what happened, there was a rush to try to find ways to get more people into homes. So we started loosening up the underwriting standards. Well, once you incentivize a loan mortgage originator that you're going to get paid $3,000 mortgage fee to get that loan through, and I can just push it through, and they're going to take it because no one else is looking at it, all you're going to get is buckets of loans coming into your door. So the question is, you're talking an awful lot about, are the government subsidies, too much, too little, and everything else. I would tend to argue, are the parameters set by the government, meaning Congress, of saying it's un-American not to own a home. So therefore, a 70% home ownership rate is fine, but when you do that, you now have about 6 million people that really should never have owned a home. They should have been a renter.
Yep.
Now, doing that, and you have an incentivization system which pays people to get more people into homes, which we found out were the no downs, or you could get a home builder to basically, quote, almost loan you the down payment so they qualify. You get a government guarantee on it. There was such an explosion, it was almost unbelievable. In fact, it got to the point if you decided you wanted to hedge your mortgage portfolio, there weren't enough 10-year bonds out there in the circulation to even do a proper hedge. So, hedging against 10 years. So my concern was, the real problem, seemed to me, and I'd like you to comment, is the mandate by the policymakers of what was appropriate policy, which got out of control.
Okay, thank you.
And what we're seeing now is, everything you guys say is, if you really had stuck to the original underwriting standards that we had back earlier, would you have had this problem? Because I know Ken, when he would look at multifamily, the underwriting standards never changed.
So
Okay.
I'm jumping in there. So I wasn't in the business back then, right? No, I was. I've 25 years as a very successful investment banker, I might add. Nothing could be worse than this. And about 3 years ago, I got asked to go in and to run Countrywide. Bank of America bought Countrywide. It's been a bit of a challenge. And so I got in to try to run the mortgage market and to resolve all these mortgages. So I've had plenty of time to do exactly what you've done. Sit back and ask these people, how did we get here? Right? How did this happen? So good government intentions, right? More home ownership, I think we all support it. It's a good thing. Keeping interest rates low so that people can afford more housing, probably a good thing. A lot of people who couldn't afford a down payment but had good jobs and could afford to make monthly payments, how do we get some no downs? Probably a good idea. Everything made sense in moderation, if applied at a very narrow level. Unfortunately, you get people who are incentivized on commissions, and you get speculators who are happy to jump in there with nothing down and ride the market up, and they're willing to tick the box that it's owner occupied for about a day, and then I'm gonna move to the next one and owner occupy it for a day, and then I'm gonna put it into a rental pool because all markets go up. It was, again, I wasn't in it, but when I go back and look what happened, I can see how relatively good policy, to some extent, ran amok. But if you want to join in the blame game, there's a lot of people who can be blamed for this. And in fact, I think no one's blameless, to be perfectly honest with you, because everybody played their part, but everybody truly thought it was going to end okay, because housing prices always go up. And provided that housing prices always go up, it would have been okay. And then housing prices stopped going up. We went through the greatest recession we'd ever seen before, and we found out that it was a real problem. So I don't want to, I know you want to blame, you're welcome, by the way.
No, I'm not blaming, I'm saying, but what's public policy?
Yeah.
The question really should be is,
Yeah.
what should the public policy be towards home ownership? Because if your public policy says, put as many bodies, home ownership is really great up to a certain point.
This will happen again.
Well, there are two things I don't think get talked enough about in terms of cures going forward. And one is regulatory treatment in the primary market, and the other is governance. The governance factor came up. I will tell you that when they had Peter Angelides, they formed this commission to look into the financial crisis, and they asked me to come, as I was one of the few bodies that was still around from when the ships hit the shoals. And they said, well, you know, they were looking for they had some ambulance chase a lawyer or something. They were looking for me to name somebody. They said, well, who do you blame? I said, everybody.
Everybody, yeah.
And so there was insufficient insulation of the GSEs from the political process. So if you look at a bank, for example, very seldom when you see Congress, I mean, you know, today people like to pick on Jamie Dimon, but it goes through the regulators. But Fannie and Freddie literally had a board of directors of the entire U.S. Congress. And by the way, the GSEs, to be perfectly frank, they played to that. They used that to their advantage, but that was very unhealthy because it was poor governance. The regulatory breakdown, which has been addressed to a degree, was that there was inconsistent regulatory treatment in the primary and secondary markets. And by that, I mean that in the primary markets, people were originating things that no one understood the risk. Fannie and Freddie didn't understand it, the banks didn't understand it, and when people went to the regulators, Donald Layton at the Fed raised his hand. I'll just say it, Chairman Greenspan, you know, that will be the mark on his record. The FDIC, the OCC, no one stopped the banks from originating it. No one stopped Fannie and Freddie from buying it. So if you have a situation where you have poor governance and at the same time you don't have what I call regulatory clarity around the safety and soundness of the product, it's a train wreck. I think they've addressed, at least in the primary market, some of it. My concern there is still that they've done it with the depositories. There's been a lot of press recently, for example, like Aquin. They're now, so a lot of servicing has moved out of the banks. Well, how are they going to be regulated? So there's still some gaps in the regulatory aspect in the primary market. And again, the governance of the GSEs, that really hadn't been talked a lot about in these bills. But if you have a situation where Congress can, you know, put the pedal to the metal, you can have this happen again.
I think you said this to me earlier, Ken, and I think we all agree that the issue, the public policy issue should start with what's the policy toward home ownership? And how much does the U.S. want to support it? Somehow we never have that discussion in Congress. It never starts with that. The administration, nowhere do we have that discussion.
I'll just add that.
And everything flows from that.
The Federal Reserve staff have looked at, you know, has there been some impact of, say, Community Reinvestment Act on leading to the housing crisis, and they concluded that they don't see any relationship between things like CRA and affordable housing goals leading to the housing crisis. There's still no question there was a sharp deterioration in underwriting quality in the single-family market. Some of it, when you look at the boom period, some of it was cash-out refi. So these are people already who are homeowners, and they're cashing out all their equity doing a refi, or they're placing a second lien. Now, the second liens really exploded prior to the crisis, and the second liens were not sold to Freddie Mac or Fannie Mae. Those were either held in bank portfolios or put into private label securities. But second liens grew to almost 15% of single-family debt in the country. So that's close to $1.5 trillion was just second liens, people cashing out their home equity, placing their second lien or home equity line of
Okay,
credit.
this young man right here.
I guess one quick question I have is an article in the Wall, and I guess it sort of relates to the previous question indirectly. There was an article in the Washington Post this week talking about how LT homes have received assistance for their mortgages immediately following the crisis. Roughly 30% of them have entered delinquency or foreclosure, and the numbers expected to rise moving forward. And I was wondering what you guys' thoughts were on that development and on the possible effects that might have on the housing recovery moving forward.
I would say I'm not at all surprised by that, because one thing that the popular image in the press is I'm the poor homeowner and the bank lied to me, they victimized me, but a significant portion of those loans were bought by people speculating on houses, using their house as a piggy bank. They lied. And when they first came out with the mortgage modification programs, Treasury wanted people to hand over all this data, and they wanted them to certify to it. And I remember they were doing lots of modifications, trial modifications, but when it came time to go final, people wouldn't hand in the paperwork. And, and I remember that this gentleman who's passed away, Herb Allison, was running Fannie Mae then, and he came and he was pounding the table. I don't understand why these things aren't converting. And we said, Herb, they can't sign it because it's a felony to lie on your loan application. And I said, if these people provide you this data, they have to admit they lied to get the loan. So I think that there were a lot of people who lied about their income. They never had the income. The housing price was inflated. So by the way, I don't think that means the program was a failure. I just don't think we should be surprised, given that a lot of people paid too much for a house that was way above their income level.
And you're talking about the HAMP modification program?
Yeah.
Yeah, so we did a lot of those, obviously. And the early HAMPs we did, to Ken's point, were verbal HAMPs. Customer just said, here's how much I make. The HAMP program didn't cause us to validate incomes, okay? If the person said, I make this, they qualified, we said, great, make 3 trial payments. Just prove it to us, right? And they couldn't make 3 trial they didn't have the money. That gave them an extra 3 months to stay in the house. They were trying to rent it to somebody else, whatever they were doing, to Ken's point, and a number of those failed. If you look at the HAMP modifications we do today, we still have a significant, what we call redelinquency rate, right? So 50, 60%, I mean, it's big. Because these families are struggling to stay in their house. They're struggling to make the payment that we're giving them. But it's a lot better than it used to be. It was 90, 95, 80% redelinquency rate when we first started the program. It's gotten a lot better now.
The one thing to keep in mind with HAMP is that you have to be in financial distress. You generally have to be 60 days or more delinquent to be eligible for HAMP, or at risk of being in default. So if you start from that, so you're 100% in default going into HAMP, the fact that 70% are performing today, that may actually be a very good outcome. Yes, it's true, 30% redefaulted. But again, you're starting from a population of 100% in default to start with. So if you've got 70% performing a couple of years later, that's not too bad.
Did you have questions?
I have a question. In Canada, the home deduction interest is not deductible, and there's no government support. What kind of homeowner participation do they have? And what kind of interest rates are they paying for their home loan?
I'm trying to remember.
I think it's
The home ownership rate's
Similar.
about the same as in the U.S.
home ownership similar.
Yeah, it's about the same.
But do they have a 30-year mortgage?
They have what we would call adjustable rate mortgages with a 30-year term.
Just like the UK.
It's very similar to the
Yeah,
UK.
just
where
every month, so when you get up to 15-20%, you.
They have a
right?
product they call the fixed rate, but it's not, it's like a 5-year arm. It's a rollover mortgage, so it adjusts.
Every 5 years?
Yes, and they call that their fixed rate product, but it adjusts every 5 years. Then they have, they offer also an adjustable rate that adjusts more like in the UK model, where it adjusts as
How long
rate.
would the maturity of the payment be?
Maturity, I believe the amortization's over a 30-year period.
Would be over 30.
I believe so.
And I think there is some form, there's an indirect form of government support.
They have a national housing.
Yeah.
They do have?
They do. It's
But-
like an FHA.
But it's much more kind of market-based and a little bit tighter, I'd say.
So what is it adjusted to? What interest rate?
Oh, gosh. It's a good trivia question. I don't
Yes,
know.
ma'am, in the back,
LIBOR?
No.
way back, all the way.
Wouldn't be library.
I don't know.
With regards to encouraging home ownership, what do you think will become the policy towards these multiple competing overinflated offers from non-residents, non-nationals from abroad that drives up home prices that people here can't afford, and now the rents are becoming overinflated, so there are demonstrations outside city buses. What do you think the policy will become towards that?
Brian, you want
Not really.
to take a shot at that
Not sure that's,
one?
I
Frank, you
don't
have
have an answer for you, sorry.
I think with prices being still depressed in so many markets, I know that's not necessarily true here in Palo Alto, but in many markets around the country, prices are still depressed. And so if you do have foreign investors or buyers coming into the market, it helps to actually support valuations. We're seeing that a lot in a lot of the markets in Florida, as well as some other really hard-hit, distressed markets where prices are low. So I think in those markets, they are still looking for buyers to come into the market, and if they're foreign buyers, that's helping to support valuations, I think, in those markets. They're supporting it. So again, Palo Alto might be very different.
And you raised the thing about rental housing, and I think particularly when you live here, this is a very strange market, California. And that's because the impediments to expanding the supply here, when you build an apartment project, for example, if I go to take one extreme, if you go to Houston, Texas, you can buy a piece of land, and in 6 months, you've got your permits and you're building. In San Francisco, in the Bay Area, if you're lucky, maybe you'll do it in 2 years. There have been projects here I know that took people 4, 5, 6 years, which means someone's having to eat all those costs. And so as a result, what happens, given the high cost of even getting started, that gives developers incentives to just, if I've got to go through all this, I want to make it the most expensive thing that I can do. So there are a lot of things here that aren't as much federal as they are state and local law, and you combine that with just where people want to live anyway. And so California and New York are two rental markets that are kind of unique just because of the local regulatory regimes.
Okay. Did you have a question? In the stripe? Did you have a question? John?
I've got the 5 quick observations and 2 questions. One,
David, would you listen?
the U.S. starting point. Right now, we have the most subsidized housing market in the world. Despite that, where it's true that in gross terms, housing wealth is the largest element in household balance sheets, not in net terms, because it's all financed. And that's why when the folks who really suffered were the financial institutions and went broke, because they held most of the equity. The question, for instance, on things like subprime was who was providing the capital to fund those crazy mortgages. And of course, what's not usually talked about, it turns out about 1/2 of all the toxic housing assets ended up on European financial institution balance sheets.
Right.
So a lot of the really bad stuff was being enabled as much by European institutions and Americans. Yeah, exactly. Sure. However, not every institution fell victim to the same stuff, because some did their due diligence and never had any trouble. So it wasn't inevitable. It may have been everybody's fault, but not everybody was at fault. Fifth observation is the size of the GSEs are limited by policy, but because they can borrow at the same rate as the U.S. government, they can take over as much of the market from private institutions as the government wants them to, since they borrow at a cheaper rate. So it becomes a policy question. So now my 2 questions are, number one, what we can see from the graph is that the private label MBS has pretty much disappeared. What would it take to resurrect it? And in that context, is there a public interest in having the GSEs involved in 90% of the origination? Or in a more rational world, what would the percentage involvement be and why?
So
Okay.
I'll go after what would it take to get the private market capital back in? That's what we do. It takes rate. They got to get paid for the risk they're going to take. That's what it takes. And they're not going to buy 30-year mortgages at 4.5%. That's not getting paid for the risk they're taking. So when it gets up to 6.5, 6.25, 6 3, there is a rate at which an investor will say, okay, I'll buy it, right? And when we can't get a rate there because it's being subsidized right now. It all goes to Freddie and Fannie. So it's just, it's rate. And then
So
it's,
it's a policy choice.
well, yes, I guess it's policy. Someone's got to tell them to stop doing it. But, and by the way,
It's a little bit more than that. It's also the.
I'm making it simplistic. It's much more complex, but that is the simplistic answer is we can't do private markets if we're competing with government markets. I think that's the issue.
I think there's also a broader issue about governance on private label securities. And until that all gets resolved, you're not going to really see kind of an emergence of a private label securities market. Now, it's interesting to contrast it with the commercial.
What do you mean by governance?
Qualified mortgage, what the servicing is gonna be like, what the pooling and it's the documentation, that who's responsible for what. And reps and warrants, all that kind of stuff has gotta be worked out.
And do you want to rely on the people who lied to you last time, the rating agencies?
Yeah.
Do you want to rely on them? That was a
That's
huge
the other
weakness.
challenge, yeah.
Well, you can get insurance for this stuff, right? And the private market should generate some insurance.
The same people who insured the bonds last time,
Yeah, that's
They
not,
basically-
that'll work out too good.
The industry went under.
not buying that insurance. But no, but to your point,
But-
yes, we are going to,
Otherwise, you end up
so listen.
We estimate that on the guarantee fees, that we need another 30 or 40 basis points in order to attract private capital. And so that's about double.
So
where we are.
The real question is, so, and, starting from a clean slate, what should the GSE's role be? How much of the market should they be and why?
Right, that's the question.
And it
Well-
seems to me that we're starting from a position where they own the market.
Right.
And so it's assumed they're gonna continue to own the market because we don't really see exactly how to do the transition. But it's sort of hard to see what the principle, the underlying principle that has them at such a scale.
And those are some of the challenges that Congress needs to try to address. And, we've heard from Leon Panetta about some of the challenges in trying to get Congress to agree on anything nowadays. But in the meantime, there are certain steps that the regulator can try to encourage, such as encouraging or directing Freddie Mac and Fannie Mae to do more credit risk transfer securities. And indeed, this past year, in single family, Freddie Mac and Fannie Mae began to issue these credit risk transfer securities where the credit risk was sold off to private investors. And I believe the goal for FHFA is to require more of these transfers going forward. And that has already been in place for a number of years in the multifamily sphere, at least at Freddie Mac.
But let me just jump in on that question, because I think I would ask the question, who is making the policy? So if you let the regulators make the policy, which they are doing now because Congress is stuck, the regulators are making the policy, and the FHFA has said our portfolios, the GSE's portfolios are going to go down 15% per year. So they're saying, rates and costs are going to go up, and transfers to add to that. The bills in front of Congress go all the way from complete privatization, where the GSEs don't exist, to, in my opinion, I think on the other end is a very realistic alternative, realistic in the sense that it may happen, not that it's the right thing, which is that the GSEs will have their names changed and everything will stay the same.
Yeah, and I want to
I
tell you
think that's a
something.
possibility.
Something significant happened this week that I think is directly relevant to this. After Katrina and all the hurricanes, there was a bipartisan effort to reform flood insurance with the idea that people were, in other words, we knew people were building in dangerous areas, so let's raise the price of flood insurance. Private insurance companies got ready to enter the market. When the bill got passed yesterday, guess what happened? It was gutted, right? Why was it gutted? Because people said, oh my God. So I'm just saying that people say they want the government out, but the problem is when you do it, somebody's got to pay, and they're very powerful interests that don't want to pay.
Yes. Right here.
Can you talk a little bit about what lasting effect, if any, you think
the rise of REO to rental will have on the mortgage market. Will lead to right sizing of ownership versus renting. Is it just a blip, a market opportunity we can take advantage of?
So, I spent a lot of time on the REO to rent. And so if you look at our portfolio, we had a number of customers who were delinquent. And we found that when we did finally, they did a short sale, or we did a foreclosure, they actually rented in the same community, nearby, their kids were in school. So we contacted them. And we said, Mr. Customer, you know, we're gonna foreclose on you, or you're gonna do a short sale. I'll tell you what, let's just convert it to a rental. Stay in the house, we'll put it we'll rent it for you, we'll take ownership, and then eventually we're gonna sell it, because Bank of America really doesn't wanna be in the rental business. And we spent a lot of time trying to, by the way, we had to get registered as real estate brokers, because talk about regulation, because now we're talking about leases, it's very complicated. What the customer said to us was, I think it's gonna take you a long time to foreclose on me. And I'm gonna live here until that happens, and then I will go rent, right? But if it takes you another year and a half to foreclose, that's a year and a half of free rent, at which time I'll move out. And then we went, I'll tell you what, we'll pay you $25,000, cash. $25,000 of cash if you move out and let us take control of it and become a renter, because we knew we could sell the house as a rental. We're getting nothing in. And most of them said, well, it's gonna cost me, I'll make the number simple, $2,500 in rent, that's 10 months rent. I think it's gonna take you a year and a half to foreclose. Now, you gotta raise your number, and eventually it became break even. So it's so complicated, because people are rational. People are very rational at this point in time. So that's just kind of the bank trying to go into the rental program. On the other side of that, though, you've seen a lot of these companies form to be rental businesses. They're buying a lot of vacant and empty houses, and then they're going out and finding tenants. It's not so easy to buy a house and keep, say, our objective is to keep that homeowner in the house, right? If we have to foreclose, we have lost. And if we have to do a short sale, we have lost, right? So that's why we spend so many minutes trying to figure out a modification or this, REO to rental business, because we don't want to, again, we're trying to, Bank of America, we have a lot more going on in these communities than just that one house. So we're trying to keep them in that house, and we were struggling to do it through the rental program. But at the end of the day, there is going to be, I think, a relatively well-developed single-family rental market. They're gonna be publicly traded, as several of them are. That's gonna be big capital moving into that space. I think the struggle they will find is when they have to, these tenants move out and they have to go in and fix up that house, they're gonna find the cost of refurbishment after 1 or 2 years a little more expensive than they thought, and they're gonna have to just adjust their prices as well.
Okay, we got to wrap up. I just want to say, so I think what the panel is saying is the government needs to reassess the first principles. How much should we support home ownership? That is not happening. That's a missing piece. And then secondly, who should pay for that support that you come up with? And I think the general conclusion is rates and fees are going to go up. How much? It depends on how you answer the first two questions. So thanks to the panel for your great work.